people, same savings, completely different retirements. Two people retire on the same day. Same age, same savings balance, same Social Security check. 5 years later, one of them is traveling, spending comfortably, and sleeping well. The other is quietly rationing, skipping things, second-guessing every purchase, wondering if they miscalculated somewhere. The difference between them is almost never how much they saved. It is almost always how they decided to withdraw it. I spent 25 years sitting across from people who had done everything right, saved consistently, paid off their homes, built real security. And the question that came up more than almost any other was not about the balance. It was about the system. How do I actually take money from this? How much is too much? How do I know when to adjust? Most retirement conversations treat the withdrawal question like a math problem with one right answer. What Morningstar's research revealed is something more honest than that and more useful. There is no best strategy. There are only strategies that fit different people. By the end of this, you will have a clear picture of all 8 approaches they tested, what each one costs you, what each one protects, and a decision framework to help you identify which one actually fits how you live. Hold that in mind as we go through this together. Here is something that surprised nearly every client I worked with on this subject. The withdrawal strategy you choose shapes not just how much you spend, it shapes how retirement actually feels. Whether you check your portfolio with curiosity or dread. Whether a down market sends you into a spiral or barely registers. The math and the psychology are inseparable, and Morningstar's research treats them that way. Before we go through all 8 approaches, let me tell you about someone whose situation may feel familiar. Her name was Diane. She was 63 years old, had spent 29 years teaching high school English outside Columbus, Ohio. She retired with $512,000 in a 403B, a pension paying $1,140 a month, and Social Security coming at $67,000. Her husband had passed 3 years earlier. She had one daughter in Portland and a sister 2 towns over. She had done everything her financial life had asked of her. She came to me not because something had gone wrong, but because she had one question she could not answer on her own, and it had been sitting in the back of her mind for 2 years before she finally asked it out loud. She said, "I don't know how much I'm allowed to take." Not how much she needed, how much she was allowed. That word stayed with me, because what it told me was that she had spent her entire working life living within a budget, contributing to a retirement account, deferring gratification, and now that the moment had arrived, she did not know how to give herself permission to actually use it. She assumed she should withdraw as little as possible. She assumed that was the safe choice. What she had never considered was that withdrawing too little, spending so cautiously that you leave a substantial portfolio untouched at the end of your life, is also a kind of failure. Not a financial failure, a personal one. The strategy Diane eventually chose changed that. Not dramatically, quietly. And that is exactly what a good withdrawal strategy does. That moment of finally understanding that the goal is not just to not run out, but to actually live, is what this decision is really about. Morningstar tested all 8 approaches on identical conditions: a 30-year retirement, a 90% success rate target, the same portfolio assumptions, the same market simulations. What changed across every strategy was one thing: how the withdrawals respond to what the market does. That single variable produces 8 completely different retirement experiences. Let's go through them one by one, and with each one, pay attention not just to the math, but to the feeling, because you'll know when you have found the right one. Strategy 1. Fixed Real Withdrawal. This is the baseline. You choose a starting withdrawal amount. Morningstar's base case suggests starting around 3.9% for a 30-year retirement, and every year you increase that amount by inflation. Picture it as a retirement paycheck. If you retire with $1 million portfolio and start at $39,000 in year one, a 2.5% inflation brings you to roughly $40,000 in year two, $49,000 by year 10, $63,000 by year 20. The market doesn't change your check. A 20% drop doesn't touch it. A 25% gain doesn't add to it. The paycheck simply holds its value. The reason Morningstar uses this as their baseline comparison is because for many people, this is exactly how they want retirement to feel. Predictable, salary-like, no decisions required during market turbulence. If the idea of opening your investment account during a down year and having to decide whether to adjust sends your blood pressure up, this approach removes that entirely. Here's what it costs you. The Fixed Real strategy supports the lowest starting withdrawal rate of all 8 methods tested. It ignores portfolio performance entirely, so if your investments do exceptionally well for a decade, you never see a dollar more. And Morningstar's research found something that surprised many people. This is the strategy most likely to leave retirees with the largest unspent balance at the end of life. Not because they plan to leave it behind, but because the system never gave them permission to spend more. Think about what that means in plain terms. You may spend 30 years being more careful than you needed to be. This approach fits you well if stability genuinely matters more than maximizing what you spend. If you have strong guaranteed income, a meaningful Social Security check, a pension, so that your portfolio is not carrying the full weight of your expenses. And if income variability, even modest variability, would affect your peace of mind in ways that no additional lifetime spending would offset. Strategy 2. Skip inflation after a loss. This one starts identically to the Fixed Real approach, with one adjustment. If your portfolio experiences a down year, in the following year you skip your inflation increase. You do not cut spending. You simply do not give yourself a raise that year. Using the same $39,000 starting withdrawal, year one is normal. Year two, you give yourself your inflation adjustment up to $40,000. But if the market dropped 15% in year two, in year three, your withdrawal stays at $40,000 regardless of inflation. No raise that year. That sounds small, but here is why Morningstar found it meaningful. Skipping one raise permanently lowers your spending path going forward, and that small permanent reduction gives your portfolio meaningfully more breathing room during the periods in retirement that matter most, the early years, when a sequence of poor market returns can do the most damage to a long-term plan. What you gain is a slightly higher safe starting withdrawal rate than the Fixed Real approach, better portfolio durability in bad market sequences, and almost no lifestyle disruption. Most people, when they live through a year like this, barely feel the difference. What you give up is modest but real. Every skipped inflation adjustment compounds over time. Across a 20 or 30-year retirement, those missed raises can add up to meaningfully lower total lifetime spending. You are still, at heart, running a conservative system. You are protecting the portfolio, not maximizing what you spend from it. And Morningstar found that people following this approach still tend to end retirement with balances considerably higher than what they started with. This fits you if you want predictable income, you can tolerate a small occasional pause rather than a cut, and your primary goal is making sure the portfolio is there, not extracting maximum value from it. Now, here is where the strategies begin to behave differently than most people expect. Strategy 3, the RMD Method. This mirrors how the IRS forces withdrawals from traditional retirement accounts after a certain age. Each year, you divide your current portfolio balance by your remaining life expectancy factor. The result tells you how much to withdraw. As you age, that divisor gets smaller, so the percentage you are drawing gradually increases. Picture it this way. You're 67 with $1 million portfolio. A roughly 30-year life expectancy gives you a withdrawal of around $33,000. Now, two paths diverge. In a strong market year, your portfolio grows to $1.15 million. Life expectancy drops slightly. Your new withdrawal is approximately $39,700. That's a 20% raise with no decision required. In a bad market year, your portfolio falls to $850,000. Same life expectancy factor, your new withdrawal is approximately $29,300. That's a meaningful pay cut, also with no decision required. From a purely mathematical standpoint, this approach is nearly unbeatable. You are always withdrawing a percentage of what remains. The portfolio cannot reach zero prematurely. Spending automatically adjusts to reality. Morningstar found that this strategy supports some of the highest levels of lifetime spending of all 8 methods tested. It's the strategy most aligned with actually using your money rather than preserving it. What it demands from you is something the math cannot provide: the ability to absorb income variability without panic. Your budget will change year to year, some years meaningfully. There is no inflation anchor. There's no fixed paycheck. The only inputs are portfolio value and life expectancy. For some people, that freedom is exactly what they wanted. For others, it's genuinely difficult to live with. The RMD method works best when you have strong income floors: Social Security, a pension, guaranteed income that covers your essential expenses, so that your portfolio is functioning more as a lifestyle layer than a survival mechanism. When the basics are covered, variability becomes something you can absorb rather than something you have to fear. Strategy 4. Guardrails. Think of this as cruise control for retirement income. You start with a normal withdrawal rate. The Morningstar example uses 4% of $1 million portfolio, so $40,000 in year 1. But rather than giving you a fixed inflation adjustment every year, the guardrail system checks in periodically on where your withdrawal stands relative to your current portfolio value. If strong markets push your portfolio to $1.4 million, your original inflation-adjusted withdrawal of $41,000 now represents only about 3% of your portfolio, 25% lower than your original rate. That triggers a raise. You take inflation plus an additional 10%. Your new withdrawal becomes approximately $46,000. The portfolio earned it, so you get to spend it. If bad markets pull your portfolio down to $670,000, that same inflation-adjusted withdrawal of $41,000 now represents over 6% of a smaller portfolio, well above your original rate. The guardrail system triggers a 10% spending cut. Your withdrawal adjusts to roughly $37,000. Not catastrophic, but a meaningful adjustment. What the guardrails solve is a question that quietly haunts most retirement plans. When should I adjust my spending, and by how much? This system answers that question with rules rather than gut reactions. You spend more when the portfolio can genuinely support it. You spend less only when the risk is real. Emotional decisions during market volatility are removed from the equation. Morningstar found that guardrails allow a meaningfully higher starting withdrawal rate than the fixed real approach, without increasing the risk of failure, precisely because the system self-corrects rather than being rigid. Compared to the fixed real strategy, guardrails give you permission to start with a higher withdrawal, and they encourage spending rather than pure preservation. Compared to the RMD approach, guardrails produce more emotional stability, tend to leave larger balances, and give your income more structure. Think of it as the middle ground, not the maximum possible spending, not the maximum possible stability, but a deliberate balance between the two. This fits you if you're willing to stay engaged with your portfolio, if you can accept measured changes to your spending, both raises and occasional cuts, and if you want to balance confidence with responsibility. This is the retiree who says, I want to spend well, but I want a system telling me when and how much. We're about halfway through, and I want to pause here for a moment, because something important is emerging across these first 4 strategies that I think is worth naming directly. Every strategy we've covered so far is, at its core, an answer to one fundamental question: How much certainty are you willing to trade for how much freedom? The fixed real approach gives you maximum certainty and minimum freedom. The RMD approach gives you maximum freedom and minimum certainty. The strategies in between are all just different points on that spectrum. The right strategy for you is the one that reflects how you actually want to live. Take a moment with this question before we go further. Think about the last full year before you retired, or right now if you're still working. What did your household actually spend in 12 months? Not what you planned, what you actually spent. Hold that number, because the strategy that fits you is the one that can sustain that number and the life behind it without asking you to live in a way that doesn't feel like yours. Strategy 5. Actual spending decline. Here is something most retirement planning tools never build in, but that Morningstar's research confirms is actually how most people live. Real spending in retirement does not hold flat. It tends to be highest in the early years, the go-go years, when you are active, traveling, doing the things you planned. It gradually declines through the middle years, and it often rises slightly again in late life, primarily due to healthcare, but usually only modestly. This strategy builds that reality directly into the plan rather than fighting it. Instead of increasing your withdrawal with inflation every year, this approach assumes a real spending decline of roughly 2% annually. You start with a $40,000 withdrawal from $1 million portfolio. By year 5, it might be around $36,000. By year 10, $32,500. By year 20, $26,500. That decline is gradual, and for many people, it is not a sacrifice. It simply reflects what naturally happens. The upside is meaningful. Lower sequence of returns risk, higher probability of success, fewer forced adjustments during market downturns. Because your draw on the portfolio eases over time, the portfolio gets more breathing room in precisely the years when compounding matters most. Morningstar found that this approach produces some of the lowest failure rates of all 8 strategies. The important thing to understand here is what you are assuming. This strategy presumes your lifestyle will genuinely slow, that travel reduces, that discretionary spending eases. If you expect your spending to hold steady or increase in retirement, this system is not built for that life. And it is worth being honest with yourself about which version of retirement you are actually planning for. This strategy is not about optimization. It is about peace of mind. And for many people, that is exactly the right trade. Strategy 6. Constant percentage withdrawal. This one is as straightforward as it sounds. Every year, you withdraw the same fixed percentage from whatever your portfolio is worth. The percentage never changes. The dollar amount changes with the portfolio. If you are withdrawing 5% annually from $1 million portfolio, that's $50,000 in year 1. If strong markets push your portfolio to $1.3 million, your next withdrawal is $65,000. That's a $15,000 raise automatically. If a difficult market pulls your portfolio down to $700,000, your withdrawal becomes $35,000. That's a $15,000 cut, also automatically. From a purely technical standpoint, this strategy is bulletproof. You literally cannot outlive your portfolio. Withdrawals shrink when markets fall. The portfolio is self-correcting. Morningstar found that it supports some of the highest safe starting withdrawal rates precisely because overspending in a down market is structurally impossible. What it demands is the ability to absorb income swings, without those swings disrupting your life. Your rent doesn't adjust when your portfolio does, your insurance premiums don't, your grocery bill doesn't. If your portfolio is funding essential expenses, that volatility is genuinely difficult to absorb. This approach works best when your essential spending is already covered by guaranteed income, Social Security, a pension, so that your portfolio is primarily funding discretionary life, travel, gifts, experiences. When that's true, a year where your portfolio income drops from $65,000 to $35,000 means you travel less, not that you struggle. That's a very different emotional experience than the same cut in a situation where the portfolio is carrying the weight of your basic expenses. Strategy 7. The Endowment Method. This strategy borrows from how major universities and large foundations fund their operations. Rather than basing your annual withdrawal on this year's portfolio value, which can swing dramatically, you base it on the rolling average portfolio value over the past 10 years. Picture a $1 million portfolio with a 5% withdrawal target. In a year where markets surge, your portfolio might be worth $1.3 million. Under a constant percentage approach, you'd get a $65,000 withdrawal immediately. Under the endowment method, the 10-year average smooths that spike. Your withdrawal adjusts, but slowly and deliberately, not in a single lurch. When markets fall, the same smoothing applies. A bad year doesn't immediately slash your income. The portfolio's long-term trend guides spending rather than its short-term volatility. This is exactly how major institutions avoid overreacting to market cycles, and Morningstar found that this approach supports some of the highest safe starting withdrawal rates while meaningfully reducing year-to-year income swings. What it costs is complexity. You need to track your portfolio's historical values over a decade. It's not intuitive without some structure, and it's harder to self-manage without a system or an advisor. But for someone who thinks in terms of decades rather than quarters, who wants higher lifetime spending without the emotional roller coaster of year-to-year volatility, and who is comfortable with a slightly more involved approach, this strategy often produces a retirement that feels both generous and sustainable. Strategy 8. The Vanguard Floor-and-Ceiling Model. This is the most behaviorally refined of all 8 strategies, and in many ways, the one that most honestly accounts for how human beings actually respond to money. Each year, your spending can adjust up or down based on market performance, but the adjustment is bounded. Vanguard's model caps annual increases, a ceiling, and limits annual decreases, a floor. Spending responds to reality, but within defined boundaries. Here is how it works in practice. You have a $1 million portfolio with a 4% starting withdrawal, $40,000 in year 1. Inflation is 2.5%, so the inflation-adjusted target for year 2 would be $41,000. Vanguard applies, as an example, a ceiling of plus 5% and a floor of negative 2.5%. In a strong market year where your portfolio does well, you might otherwise justify a much larger raise. The ceiling limits that. Your increase is measured, not a lifestyle leap. This protects you from the well-documented human tendency to ratchet spending up during good times and then find it painfully difficult to cut back when conditions change. In a bad market year, the floor limits how much your spending can fall. A portfolio drop that, under a different system, might trigger a significant cut, produces only a small, controlled adjustment here. You absorb it without belt-tightening panic. Morningstar identifies this as one of the most behaviorally realistic strategies available, meaning one that people can actually live with over a full retirement, not just in theory. It acknowledges 2 things that are simply true about most of us. We do not like big spending cuts, and we are often tempted to give ourselves a large raise when the market has a great year, something we tend to regret when the market then has a poor one. This approach is not the highest spending strategy. It's not the most mathematically efficient. What it delivers is consistency, structure, and a retirement that doesn't feel like it's being dictated by headlines. This is the retiree who says, "I'm fine adjusting, I just want to adjust within limits I can plan around." Now, here is the thing Morningstar is most direct about in their research. And I want to deliver this to you as clearly as I can because it is the organizing idea behind everything we have just covered. Every increase in lifetime spending requires accepting more variability. Every increase in stability costs you lifetime spending. There is no exception to this. There is no strategy that gives you both simultaneously. The question is never which strategy is objectively best, it is which trade-off you are genuinely willing to make, and then sticking to that strategy through both the good markets and the difficult ones. A perfect strategy that you abandon during a down year produces worse outcomes than a simpler strategy that you hold through everything. This is what Diane eventually understood. Not just which strategy fit her numbers, but which strategy fit her. She chose the guardrail approach, not because the math was perfect, because she said, I want a system that tells me when to adjust so I do not have to decide during a bad market when I am most likely to make the wrong call. That was her answer. Yours may be different, and that is not just acceptable, it is the point. Let me give you a simple decision framework to help you find yours. Start with the most fundamental question. Do you need predictable monthly income? Something that feels like a paycheck, or the number is consistent and you can build a monthly budget around it. If the answer is yes, the strategies that fit are the fixed real withdrawal, the skip inflation approach, or the actual spending decline method. All three provide that salary-like consistency. If you are comfortable with income that adjusts over time, the next question is how much flexibility you actually want to manage. If you want rules that handle the adjustments for you, the Guardrails or the Vanguard Floor-and-Ceiling Model give you responsiveness within structure. If you are genuinely comfortable with wider swings and want to maximize what you spend over your lifetime, the RMD approach, the constant percentage method, or the endowment strategy all point in that direction. Then ask yourself one more question and answer it honestly. Are you planning to spend your portfolio or to preserve it? If your intention is to use what you built, the RMD and constant percentage strategies are designed for that. If your intention is to leave something meaningful behind, or if the idea of spending down your savings creates genuine anxiety, the fixed real and actual spending decline approaches are built for that posture. And finally, how strong is your income floor? Social Security, a pension, any guaranteed income that does not depend on market performance. The stronger that floor, the more of your essential expenses it covers, the more variability your portfolio strategy can carry without disrupting your actual life. If your essential expenses are largely covered and your portfolio is funding how richly you live rather than whether you live, that changes everything about which strategy makes sense. Before you close this video, I want to leave you with one thing that I think matters more than any of the 8 strategies we covered today. Retirement income planning is not a math problem you solve once and never revisit. It is a living system. The strategy you choose today should be one you can return to in a bad market year when everything in you wants to make a change and still trust. Because that is when the strategy actually earns its value, not in the good years, in the difficult ones. The retirees I worked with who felt most secure in retirement were rarely the ones with the largest portfolios. They were the ones who had chosen a system they understood, believed in, and could hold through uncertainty. That calm, the specific calm of knowing you have a plan that accounts for reality, is what a good withdrawal strategy actually delivers. If something in this video helped clarify a question you have been carrying, I would genuinely like to know what it was. Leave it in the comments. I read everyone. And if you know someone who is working through these same decisions right now, share this with them. This kind of clarity is almost always easier when you're not working through it alone.